Hi, and I'm Michelle Brady, the Equity Trust National Brand Ambassador that's joining you on this webinar today. And I thank you for joining, and I'm also joined by Vicki Perry, and she's the Executive Director of Central Indiana Real Estate Investors Association. So thanks for joining, Vicki.
Thanks, Michelle. I'm happy to be here.
Well, it is a pleasure to share this webinar with you. And what we're going to do in our time together is discuss not only the Real Estate Association in Indiana and the National Real Estate Investors Association sponsor benefits. And then we'll get into talking a little bit about self-directed IRAs. But let's go ahead and talk about what's going on in Indiana. So Vicki, I know I have a slide for you there. So what's happening in Indiana?
Well, we are Central Indiana's premier real estate investors association, known as CIREIA. We're the oldest and the largest nonprofit real estate investing group in the state. And we help people at all levels, whether they're new or they're seasoned professionals. We have information that can help everyone. We have a website at CIREIA.org. We have a main meeting on the first Thursday of every month. And then we have 12 small subgroups every month that talk about rehabbing or landlording or buying and selling notes. We even have a subgroup that is open for women to talk about specifically what women go through in this crazy world that we're in. In addition to that, we do some special events. We have some special events coming up in May. We have the first annual mini conference for the state REIA that we are going to be hosting with 6 speakers, including Equity Trust. And then we also have a special event in April where we talk about passive investing, where people can crowdfund their money and use a smaller amount of money to get into the investing world.
Wow, you have a lot going on in your organization, and that's very exciting. So can guests attend your meeting with a charge or free, or is there a cost?
We welcome guests to come to any of the special events and to come to all of the main meetings on that first Thursday of the month that I mentioned. There is a cost, but if they join, the cost to get in is applied toward their membership fee. And then all of the subgroups, the smaller meetings that meet 12 times a month, those are for members only.
Okay. Well, one other question is where is it that you actually meet?
The main meeting on the first Thursday of the month is at Broadmoor Country Club, which is at 2155 West Kessler Boulevard in Indianapolis. The other meetings depend upon the group leader. For instance, our rehabbing subgroup is up on the northeast side of town. It just depends on where the leader is and where he or she decides to hold the meeting.
And I bet they find all that at your webpage at CIREIA.org.
Yep, CIREIA.org.
Let's go ahead and talk about the fact that you are a National Real Estate Investors Association member and what that means.
Well, as a member of CIREIA, all of our members are also members of National REIA, which is a really nice benefit. They don't pay any extra money to have that opportunity. And not only do they get to enjoy vendor members or partner members like Equity Trust, we also have partnerships with Home Depot, Office Depot, and as the slide shows, several other companies. We also have the opportunity to participate in the National PHP program, which is the Professional Housing Providers. That is a 60-hour course that allows our members to learn all the different facets of investing, and then it's a designation that's recognized nationally. So it's pretty exciting.
Wow, you have a lot going on there. Well, I'm so glad that you had an opportunity to be part of this webinar. And of course, Equity Trust is one of the National Real Estate Investors Association Gold Level sponsors. And we'll be sharing about what that benefit means at the end of this webinar. What we'd like to do next is begin to talk about self-directed IRAs and what that might mean for you as a real estate investor. Welcome to this webinar on creating tax-advantaged investments and self-directed IRA basics. During our approximately 30 minutes together, we will cover self-directed IRAs and your self-directed IRA investments. Hi and welcome. I'm Michelle Brady. I'm one of the National Brand Ambassadors here at Equity Trust, and I look forward to spending this time with you, sharing how you can learn about not only tax-advantaged investments, but work with Equity Trust. To begin, Let's review that Equity Trust nor Equity University, our affiliate, is providing this webinar for anything other than educational purposes. It's not our intention at Equity Trust to provide you with personally applied tax, legal, financial, or individual advice. When you're evaluating the material in this webinar and applying it to your personal life, we recommend that you work with a professional who does that for you, such as a financial planner, a tax advisor, a CPA, and of course that you perform due diligence on the investments that you are considering. So again, we welcome you to this webinar. Equity Trust is a leader in self-directed IRAs. We have over 40 years of experience. We're an IRS-approved custodian, and on our platform, you not only can invest in the traditional investments such as stocks, bonds, and mutual funds, but we also offer our customers the opportunity to invest in alternatives. And as a customer service-focused company, we look forward to serving you. Let's start with a question. Did you know that your IRA can own real estate? At the same time, did you know that your IRA can lend money in order to purchase real estate or assist in a real estate project? If you didn't know the answers to those questions, those are the things that we will be covering in this webinar. And so what we hope to review are the 7 different advantaged accounts, a case study of an actual self-directed IRA investment, and also how you can get started with Equity Trust. When you look at this slide that you see before you, there are 2 eggs on it, and they look exactly the same. And that's because they are exactly the same. A couple of times so far, we've talked about self-directed IRA. And so let's define that. A self-directed IRA is the same thing as a regular IRA. These eggs are exactly the same because a self-directed IRA is an industry term. And it simply means that in addition to traditional choices such as your stocks, bonds, and mutual funds, the self-directed IRA customer has the option to invest in alternatives. So what kind of alternatives might you consider in a self-directed IRA? Well, they're the things that fall under the real estate category is a primary choice for a lot of individuals. If you look at the list in front of you, these are the options that fall under alternative investments that can be placed in a self-directed IRA that fall under real estate. And they include a single-family home, to rehab and resell, an apartment building or a mobile home park. Some people enjoy investing in mortgage notes or trusts or tax liens and deeds. Perhaps you're interested in real estate options or wholesaling, or you'd like to buy land to develop or hold. And in fact, you can also hold precious metals of certain purity inside of your alternative investments. In fact, there's only a few things that are prohibited from being held in a self-directed IRA, and they include art, collectibles, alcohol, life insurance, and investing in an S corp. So as you can see, quite a few things can be held inside of an alternative investment choice as part of your individual retirement account choices. So let's talk about these IRAs and either taxing the crop or taxing the seed. Now that's important because your IRA choices are taxed differently. And so the IRS handles them and sees them as 2 different vehicles. Let's cover the 2 different choices that you have, and they fall under many different names. We're going to start with taxing the crop. When we refer to this, it was the original IRA options that were presented to the public. As you heard of them, most people heard of them through their employers who sponsored the options that were presented to their employees. And they went by the names that the employer referred to them as, including a 401k-B, which was the most common. If you received a 403b, you worked in education as a teacher. If you had a TSP plan, it was with the government. And if you had a pension plan, that was also offered. And of course, we heard many of those have gotten into trouble with funding issues. If you worked for yourself, you also had the option of having your own plan. And they fall under different names too, 3 different names. They were called SEPs, solos, and simples. These categories right here were called employer-sponsored plans because your employer administered them for you. Now, it is also possible for you to have an individual retirement account separate from an employer, and that is what we do here at Equity Trust. Is we open what are called the traditional IRAs that fall under the taxing the crop category, which I'm going to explain next. When we talk about taxing the crop, how these plans work is this. You select selected an amount of money that you wanted to put into the plan according to the plan's contribution limits. You see before you what the current IRS contribution limits are. If you're under 50, then your contribution limit is $5,500. When you are over 50, you are enabled to have what is called a catch-up contribution, an extra $1,000. So it brings you to $6,500 a year annual contribution limit for a traditional IRA separate from an employer. Now, when you submitted this money to your plan, how this worked is that you took a tax deduction off of your taxes because you're not paying taxes on this money yet. The goal is that you take the full power of your dollar from your income without taxing it and then invest it in order to grow it as a savings for your retirement. And then upon retirement, when you withdrew this money, you would pay your taxes. So this is often referred to as a tax-deferred plan. You deferred your taxation till retirement. Here at Equity Trust, we refer to it as taxing the crop because you put your funds in and then you intend to grow it through your investment choices. And as you grow it, you then have a bigger pot at the end for your retirement funding, and you get taxed as you do the withdrawal. So this is called taxing the crop. Now, your contribution limit is $5,500 for a traditional IRA unless you're over 50, and then it's $6,500. And then you're also entitled to spousal contribution, meaning if your spouse would like to have their own plan, you both are able to contribute to separate plans. You've tax deducted your contribution off your taxes, and then you don't pay ordinary income tax until you withdraw the funds. Now, normally your withdrawal date is at 59 and a half. If you withdraw your money prior to 59 and a half, you could be subject to penalties. There are some exceptions for that, and we recommend you work with your financial professional to assist you with those if you choose to withdraw your money prior to 59 and a half. You do not have to withdraw your money at 59 and a half. In fact, if you choose to wait, you can wait until you're 70 and a half. Now, if you're listening to this webinar and you're approaching 70 and a half, your tax professional will work with you to determine what are called RMDs, or required minimum distributions. Because at 70 and a half, it's time to start paying taxation and withdrawing the funds. For the rest of your lifetime, a RMD, or required minimum distribution, will be determined so that you can withdraw your funds and begin paying your taxes that are due on this account. So this is what is called taxing the crop. Now let's introduce the other one, taxing the seed. A few years later, in 1997, Senator William Roth approached Congress with another plan that said, let's go ahead and let individuals who hold individual retirement accounts pay their taxes up front. It's the same contribution amounts of $5,500 when you're under 50 and $6,500 when you're over 50. The advantage to Roth has a couple of forms, and one of them is this, that as you invest your money that you have paid taxes on and contributed to the Roth IRA, it would grow without additional taxation upon withdrawal. Your taxes would not be assessed additionally because you've paid taxes on the seed as long as you follow the rules of a Roth IRA. One of the other interesting features of a Roth IRA is because you have paid money on the taxation already on the money that you've contributed to this fund, you can withdraw your contribution amount at any time without taxation and without any penalties, which is not the case with a traditional IRA. You would have penalties if you withdraw your money early. Now, you cannot withdraw your growth or the proceeds that you earn off of your investments until you're 59 and a half. And you have met two other rules. And the other rule is called seasoning. What seasoning is simply that there is an amount of time that the funds have to be kept in a Roth IRA before you could enjoy the tax-free growth privileges of a Roth IRA. So seasoning, 5 years, means that the money just simply needs to stay in the Roth IRA account for at least 5 years before you can enjoy withdrawals at 59 and a half. If you open a new account at Equity Trust, one of the questions that we get asked is, I started an account somewhere else, and I'd like to open a new account with Equity Trust as a Roth IRA. Do I have to start seasoning all over again? The answer is no. From the date that you begin opening a Roth IRA, you do not have to restart seasoning on a new account that transfers funds over. Now there's another rule with Roth, and the Roth is called the MAGI limits, or the Modified Adjusted Gross Income Limits. Here's what this means. If you earn over $200,000 a year, then you are unable to directly contribute to a Roth IRA. There is another way for you to get funds into the Roth IRA account though, and it's called conversion. What would happen is that instead you could contribute to a traditional IRA at your contribution limits, and then do a process called conversion, in which you transfer or you convert your funds into the Roth product and then pay taxes. Once you pay the taxes on those funds and have it in the Roth environment, you have moved your funds into that type of form and paid the taxes, and then you would have a Roth vehicle. And so there are choices for those who meet MAGI limits to do that process called conversion. So the Roth IRA is interesting and different from a traditional IRA in that it grows without additional taxation. So you have two choices when you are considering your IRA. You also would want to know about two other forms of accounts. We'd be remiss if we didn't let you know about the Coverdell Education Savings Account as another option for investments for those who have children. CESA, for short, is an account that is eligible for students or children who are under the age of 18. If you have a child that's under the age of 18, you can contribute. Currently, the contribution limits are $2,000 per account for each child annually. Now, the funds are not earned by the child. They are given to the child by anyone who wishes to contribute to the child's education fund. The interesting thing about a CESA is that it grows like a Roth, and that there is not additional taxation on the invested growth or profits that are made within the account through the investment vehicles of your choice. The money, if withdrawn for the education purposes of the child, is not additionally taxed, and so it operates like a Roth. Now, for the purposes of this webinar, we don't have time to review Coverdell education accounts, but if you'd like to earn or learn more about that, we would like to share that with you here at Equity Trust, and you can call us at the end of this webinar, and we can help you understand CESAs in more detail. Similarly, there's another purpose-driven account called the Health Savings Account, or HSAs for short. HSAs are one of the most interesting accounts because it enjoys the privileges of both taxing the crop and taxing the seed. It is both a tax-deferred and tax-free growth if following the HSA's rules. So let's cover what those are. In order to have a health savings account, you first have to have a qualified health care plan behind it. You first have to have what is called a high deductible health care plan. When you select a high deductible health care plan, then you can have a health savings account to help you support or pay for your medical expenses. When you contribute your funds, and those contribution limits change, and we would be happy to provide those to you when you call into Equity Trust at the end of this webinar. But those health savings account contribution limits are then submitted to the account. They are deducted from your taxation, just like a traditional IRA deducts it from their taxation and their reported income. Then, as the funds are invested, and many people don't know that a health savings account can be invested, but as you invest it in your choices, whether it be in traditional stocks, bonds, and mutual funds, or the self-directed options that Equity Trust enables you to be able to have, then as it grows, if it's withdrawn for medical purposes or for the healthcare costs, it would grow without taxation and be withdrawn in order to pay those healthcare expenses. And so the health savings account is unique in that it enjoys both tax-deferred and tax-free growth statuses. So we have just explained the taxing the seed versus the taxing the crop choices that you have. Here at Equity Trust, we open the accounts for our customers that fall under both categories. We open the Roth and the traditional IRAs, the CESAs and the HSAs, and also the small business plans that were mentioned, the SEPs, SOLOs, and SIMPLEs. As you work with your financial professional, you can determine which one is best for you. Are you ready for a case study, an example of how someone utilized these vehicles in order to help them grow their retirement funds? Well, then let's introduce you to Wayne and Alicia. Wayne and Alicia are from New Orleans, and as they experienced the hurricanes that happened in their state many years ago, they saw an opportunity to both help their community and also utilize their self-directed IRA and equity trust to improve their retirement account as well. So let's explain what they did. Wayne and Alicia saw a property that they could rehabilitate that was for sale. They partnered together, and as a couple, they are not prohibited from partnering together as long as they clearly delineate their partnership arrangement. And so it was 75% of Wayne's Roth IRA and 25% of Alicia's Roth IRA were investment partners in this project. They invested a total of $106,000 in the total project, including the purchase and rehabilitation of the project. Now, this is how the title of the project is done when it's under a Roth IRA, because Wayne and Alicia do not directly own this project or this property. Instead, Wayne and Alicia's Roth IRA own this property. And so the title reads Equity Trust Company, and FBO stands for the benefit of Wayne and Alicia's Roth IRA. So as Wayne and Alicia's project moves forward, understand that they cannot directly do the rehabilitation work on this property because Roth IRA's owners are prohibited from doing that. So they have to hire a contractor, and they hire Sean, who is not only a contractor but a rehab specialist. They pay Sean out as $106,000 of proceeds. When the project is completed and sold, the repaired home sold for a profit of $37,541. That's a return on investment of 35.4%, a very good return on investment for this real estate project. Now understand that these funds, this profit, does not go back directly to Wayne and Alicia. Instead, it goes directly back to their Roth IRA. And because it was a Roth IRA, the profits are going to be tax-free as long as Wayne and Alicia follow the rules of the Roth IRA. Further, the profits are distributed according to their original partnership arrangement of 75% and 25% back into their accounts. So this is an example of how a Roth IRA can be invested in a self-directed IRA choice. It was a pleasure working with you and explaining this information about creating tax-advantaged investment choices here at Equity Trust, and that we provide our customers with both traditional and non-traditional investment choices. We look forward to working with you and developing your account with Equity Trust. Let's explain that next.